All right, this is how I trade part two. This is going to go over the concept of supply and demand. So just to get into it, consider what I said in part one. The market will break a low and then return somewhere and then continue breaking more lows. That was the concept in our market structure video. We said that when the market puts in a new low, it will continue to make more lows. But now here's the glue that ties us together. Where does the market return when it breaks the low? And how do we know when it's going to turn around to break a new low? Or to make a new low, I guess. And basically that's the concept of supply and demand. So in this area on Euro Yen here, we have supply and demand areas, and what those are is they're basically the turning points in the market. I would define them as the turning points in the market. Sometimes they're swing points. We could even go back as far as here. We can see some, and let's define what those look like. Let me delete this. So I would point them out as these engulfing patterns here. So you have this lower candle, which is engulfed by this higher candle, this bullish candle. On this area here, you have, you have this bearish candle in the middle here, which is engulfed by this bullish candle here. Now, a lot of these bearish candles are like two-part engulfing, and this would also be an area of supply. So on the bottom, that's called demand. That's called demand. On the top, we call it supply. It's another word for support and resistance, but I don't count these whole areas as support and resistance. I would just say that's supply and demand because they're really just like blocks of, I guess, orders. Like people call them order blocks, I think sometimes. I don't know. But basically, yeah. So when you have a two-part engulfing like this, this would be your area of supply. I'll mark that green so it stands out. I'll delete this. Now, within that area, within those areas, you can see that there's a bunch of wicks. What you want to do when you're marking out these areas is you just want to take the body of this, the last up move before the down move, or the or vice versa for bullish. Now basically when you take this here, what you're saying is you take the bottom body to the top wick, and then what you want to do is basically wait for price to return to those areas. So for example, you can probably already see some of these things bouncing here, but when we break this low and this low, right, we want to wait for price to return to an area of supply or demand. Now the first area before this break of those structures would be here. This is the last up move before that down move, right? And I'm taking like the high of the area, basically. So the candle body to the high of the area, and then we're just waiting to see what happens when price returns there. So price comes down, bounces, and then we see a rejection candle here. Now for me, when I see this, I wait to see if price breaks the high, and if it makes a bearish engulfing before breaking the high, then I will enter the trade. I call this the 1 2 3 pattern. I think that I'll probably make another video just based around this, and then I would just target 1 to 3. That's kind of funny. I didn't realize that. Anyways, right? So that's how I would trade these areas. If you go and you look at, I mean, the most important point is to go with order flow. So like you'll see that if you try to take a sell here, for instance, we didn't get an engulfing candle, thankfully, but sometimes there would be. But this would be the point that price is reversing, right? So this is where you might get stopped out if you were selling right here. However, if we look at this whole trend here, you can see that we have this area of supply. You see, this is the last up move before the down move that led to the break of structure. So it led to the break of this structure here. And we came back up and we made this engulfing pattern. Now, you don't have to wait for the engulfing to close unless you, I mean, if you see that it's making a really fast engulfing and it breaks past the low of the previous bullish candle here, you can enter here if you want to. You still want to put your stop above the previous high that created the block though, or created the area of supply though, right? So I don't know if I'm going too fast on this. I might also have to redo this video, but this is just like off the cuff, trying to show supply and demand, right? So then we continue and you'll see areas like this where sometimes we have an area of supply that leads to a break of structure. But when price comes back, it runs it, right? Sometimes it'll run it, and that'll happen. However, my rule for this is that as long as a body doesn't close above the high of the supply zone, then the supply zone is still valid, at least for continuation, right? So if we get an engulfing candle, which we do right here, before a body closes above the high, then I will enter this trade. And that would look something like this. In this case, I would just give I'd give some more room above the high. The idea of this is if it goes above this high anyways, then you're wrong. Like you're just wrong, and that's fine. It's okay to be wrong. So yeah, if we look even at the highest swing, what you'll notice is that a lot of times if price overall is like a certain direction and we do a massive push to the downside, when we come back up, a lot of times it'll go to the previous swing point. It'll start making its way at some point to the previous swing point, and that is also an area of supply. As you can see, last up move before the down move, body lower area to the wick high, and then that is actually where we bounced from over here, right? And you could have started entering when we made this engulfing candle here for this trade to catch this reversal. Now, sometimes you need to be paying attention for this, but basically just know that just observe, backtest this if you need to. Like look wherever price is going to bounce, like it's probably going to be at an area of supply or demand. Now let's go to the uptrend side. And basically you can already see, like this is a little bit cleaner, I think, but sometimes basically there's other times where price won't go all the way down to the area of demand or supply, right? And so this is one of those cases where we came up and we came down and we missed it. Oh no. Well, that sucks. I mean, sometimes that happens. That's okay, right? But you just want to be aware of that. Most of the time, it does bounce. As you can see over here, we had this area that established the area of demand. We created another area of demand here while bouncing. Another area was created here, and another area was created here. But when we came back up to this, sometimes we miss it. But what you have to understand, and what I probably am not going to do a good job of explaining, is that when this is bouncing like this, and you have some kind of valley like this, usually it's playing off a higher time frame area of demand. So if we went to the 5 minute, actually, you know what? Let me go back and let me mark these yellow because we need to understand where we're at. And I have a ton of drawings on the chart, but this is the area where we bounced from on that 1 minute chart where we missed that area of demand. Let's go to the 5 minute and see what happens. Okay, so there's still missing price there, but look, these candles are starting to compress, right? Let's go to the 10 minute. Now look at that. It's a 10-minute area of demand. So now that's what we're bouncing off of. And that is why price will miss these areas sometimes, right? And you have to understand that, like, there's multiple area, like, price is fractal. So if you pull out your X-ray goggles for a second, you can always find an area of demand that price may bounce from. And sometimes you want to mark those off on your chart. I don't. Usually the way that you would capture this, or that I've been capturing this lately, is just use a fib here to here. And then boom, look, we pass our 50%. I only take fib trades past 50%. We don't get any engulfing candle until about right here, right? And that's not even an engulfing candle. I'd say this is the first engulfing candle. But with this, you would have caught your higher time frame area of demand. And you could place a trade right there. Now you'd be a little sad trying to catch your 1 to 3, but you would catch it. It would just take you a little bit longer than you wanted, right? So that's how it works. But coincidentally, in this specific case, if you didn't take that higher time frame area of demand, let's say that you waited, it would have come back to this lower time frame area of demand again. Now I already have a lot of drawings on the chart, but let me just remove this. This would be the area of, well, this one would be the area of demand that I'm talking about, right? We have our engulfing candle here, we have our base candle here, and this is where we could have caught the trade from. So that's supply and demand, the concept of when price makes a new high and we're expecting a new high to be put in, it returns to previous areas of demand. Or if price makes a new low, right, and we expect a new low to be put in, it'll return to a previous area of supply. And that's usually the area of supply that led to the break of structure, which this one led to the break of structure. And then just to recap, if it gets run, just if you want to, and you still want to enter the trade, just make sure no candle body closes above the supply zone. Wicks are fine, because that's just a liquidity grab, which we will go over in another How I Trade video.